Hello ladies and gentlemen, and welcome back. Well, the Ripper rallies have begun in the stock market in 2022 again. It seems like deja vu when we saw some of these previous rallies where gaps happened and they just kept running through those sessions. The good news for both the bulls and the bears is opportunity is still on the horizon. For bears, they're looking at where the turning points are, and we'll be talking about all three of these zones in today's video and why they may hold the keys to the market turnarounds. But on top of that, the stats actually look pretty good for the bulls right now. Everyone's bearish, the put call premiums are out of control, and of course, we also have a whole bunch of negative news, which usually means the positivity is just around the corner. The most important thing right now, though, is of course earnings season, and we have the big tech stock coming up. The first one to kick off the season, Netflix, and after the banks have done pretty well, maybe Netflix holds the key to the next move. Well, welcome back everybody to the Daily Show where we discuss stocks, commodities, and cryptos. Of course, we've got all of those today. We're going to go through some data, some macro information, some lead indicators, and then we'll get into the charts and the key levels that we should be watching together right now. Let's talk about panic and euphoria. Of course, whenever we see a huge amount of weakness in the markets, and that sits below this negative 0.2 reading, we tend to usually have fairly good turnaround stories. Now, percentage of the time that we sit down here, only 4% of the time in the recorded history here do markets actually sit in this panic euphoria model low. And generally the annualized returns become very positive out of this level. So what does that mean for markets moving forward? Well, here's some stats over the next 1 week, 2 weeks, and months, etc. Now, 100% of the time when we've had this reading, we've generally seen a upticking market. You'll notice here some of the reads that we've had before, and the most important one is always to go to the global financial crisis because there's a lot of similarities with the current 2022 market and this market here. What you'll notice is we got this kind of announcement right around that sideways before that final fall, which caused that capitulation. Well, interestingly enough, the market at the moment is kind of doing a little bit of sideways, albeit very large moves. So the stats are pretty favorable there, but what other things do we know right now? Well, we also know that there's a huge put call premium imbalance. This is the third week expiration of options. That means that the most amount of options expirations generally happen in this week of the month, and it's that one time where you start to use what we call maximum pain. We'll be talking about that later on today's video. But notice here how crazy the put call premium has gotten. It's over a 3 ratio. That's not really positive for the bears because it means that there's just stacked amounts of puts, and it's probably more profitable to keep these markets up, whether it be in a sideways market or even just a slightly bullish squeeze. Both of them would be more profitable for the market makers. And let's face it, the market makers are some of the biggest players out there in the current worldwide scape. Let's talk about showing excess pessimism. Again, more pessimism models just really hitting those kind of unique high levels. Again, we reached that at this point in 2022. And if we look at some of the stats around these periods of time, they're pretty favorable. Even when we got it during some of those times, such as 2008, the overall stats 1 week, 2 week, and 1 month later were positive. In fact, 100% of the time they were positive over that period. It's another kind of bullish statistic for now, even though I can understand why so many bears out there would be freaking out about the markets. And it's very valid. There's a lot of problems in the world right now. Sentiment specific models nearing, of course, that maximum pessimism, again below 10% here. Only 2% of the market time do you see a reading like this. And again, the annualized returns theoretically are pretty good off this level. There's one last one though that I want to mention, and we did put this in a video on the weekend, and remember to subscribe guys if you're interested in finding out more data like this because we do it daily here on the show. And this is the divergence model. It basically shows us the percentage of SP 500 stocks that are registering new 21-day lows. Now, we had a lot falling off the cliff the other day, but in comparison, while we had big stocks falling to new lows, we didn't necessarily have the whole market falling. So it wasn't like that fearful capitulation that you usually see. It was a new low with divergence. Now, we've had that a few times in 2022. You'll notice over here, it was a very similar time. We had a whole bunch of new lows, then we came down to a new low point, and we had that divergence between the lows and how many stocks were actually making new lows. This tends to owe, again, to the positivity side, and it tends to actually lead into some bullish statistics. We've had this reading a lot more, so we've got a better data set. And when we take a look at it again, 1 week later and 2 weeks later tend to be better than a coin flip positive, and then it starts to get a little bit more muddied. While it's still positive overall, you get more into those 50s and low 60 ranges. So there's a decent amount to like about the markets right now from a stat side, from a historical standpoint. We know, of course, seasonality points towards turns at these points in the year, especially during midterm years, though we're not really following that one right now, because if it was following that, October should have already been relatively bullish at the start. It has not been. Here's the biggest sell-offs over the last 200 years, if you want to pause the video and take a look at all the data there. But just remember, at the moment, we're running a couple of stats over the last couple of weeks. Firstly, Fridays have been very negative in general, so that's something to watch out for coming into this options expiration week. Fridays, over the last, let's say 10 Fridays, have mostly been negative. And of course, at the time of this recording, the previous Friday was also negative. So it was actually 11 Fridays of pretty bad overall returns during those days. Here are the most correlated markets. Every one of them except for 2007-8 was a turning point for these markets at these points: 2001, 1965, 73, and 61. A few people in the comments are pointing out, yeah, but Tom, it's not during the same time. None of them are during the same time. It's just similarities, and we're just stacking the odds again in our favor. Will the technicals also tell us something very similar? So we know that we're in earnings season, and we know right now that banks don't seem to look like they're in a recession. Now, you wouldn't expect banks to feel the brunt straight away. It's going to come a little bit later on when it does hit them, in my opinion. However, we do know that consumer discretionary is going to be one of the big kind of warning signs. And we've got Amazon coming out next week with their earnings. That's going to be one I'm watching closely. I also think the market's going to care a lot about Netflix and quite a lot about Tesla. So these two in particular, along with advertising revenue, things like Google, Alphabet, they're going to be some of the most watched earnings season. And this is what could kick off either some negativity or continued positivity in markets. Watch the Netflix after the close Tuesday. After the close Wednesday, Tesla fans will be, I think, a little bit nervous about this earnings report. But overall, it's always been positive so far. And while Tesla's probably going to beat a lot of expectations, it just really is a question of what does the street want to value the stock at now. Remember, it's still in growth phase. If it misses even a little bit of expectations, bad things can happen. I'm sure a few of you have traded growth stocks before, and you know that even if you miss a little bit, even though on the surface it looks good, it can turn very nasty. Let's talk about the VIX. We won't really go over this too much. 31.36. We're still looking for that capitulation in 2022. We have not seen that, which kind of points towards whatever this rally is, probably is not the low. Usually we see a very high VIX at some point, which comes with a fear or a maximum fear kind of situation. Let's talk about yields. Yields continue to be incredibly high, 4.43. We saw some pullback in them over the last 24 hours. Some people will use that as the excuse for why the markets went up. I don't really think so. I think it was more just to do with squeezing these options positions as much as possible. And that's the main aim here for the markets. But we've got that 5% to 4.5 being a big blocker in the future. If we take a look at the forward yields, let's have a look at the 10-year here. You'll notice the 10-year at a resistance as well. And where we're going, if you're a new viewer of the channel, by April of 2023, it's expected that the Federal Reserve will raise rates to 5%. Now, a lot of retail public have no idea this is coming for them. I know a lot of you guys do, but just remember, that's an amazing advantage you have over the general public in certain things in life. Being able to understand the forward yield is insanely powerful for certain investments, and also insanely powerful for just understanding when you want to be a little bit tighter with your pocket strings and when you want to potentially splurge a little bit more. Changing that yield, you'll also have an advantage in the future knowing something before the general public will. Remember, the media doesn't really talk too much about the forward yields. That's where you want to be, guys, and follow the channel because we will be covering them as well, pretty much for, I think, the foreseeable future, the next couple of years for sure. High yield bonds as well is something that we can look at. Here we have, of course, the high yield kind of junk corporate bonds. And this has been a good reading of whether the market is nosediving or not. We saw that low form and then instantly rebound. So the bond market came with the stock market in this case. That's a small tick because what it means is that the bond market and the stock market were synergized together. Then we had a little bit of a negative day, which was the Friday. Well, that was pretty much expected. They were together. And as of the Monday, we went up again. So technically, high yield corporates are coming with the market at this stage. That's a positive sign for the bulls. What's a little bit sad for a lot of people, I'm sure, is buying treasuries. Now, treasuries, TLT, theoretically, is one of those investments most people go to during recessionary times. It's not like we've seen the yield switch too much in the last couple of days, but treasuries continue to dive here. And I mean, they may be going towards this really exceptional level of $90. I did think they'd find a little bit more buying here, but we never saw the turnaround signs. If you actually scroll in, look at the weeklies, no bullish weekly and only 2 bullish days through all of this action. So what I would have loved to have seen is some structure formation, a break, and then that to confirm that we're doing better. At this stage, treasuries unfortunately could be moving down to $90. But what an incredibly interesting chart to look at in the future. If these get down here, I'll set a little alert down there just in case. It's always worthwhile having those alerts. It's a serious inflection point, I believe, for markets. Let's take a look at the US dollar. It did exactly what we talked about. Weakness, weakness, weakness. Yeah, it was pretty much exactly in line with what we'd hoped. Now, the market has hit that next little level of demand, and you'll see that it went right down. Actually, probably made a slightly lower low, and now it's bouncing a little bit. I could see the US dollar find a little bit of strength, but hopefully now it turns and makes a new low. So I'll set a little alert for underneath the new low. That's always good to know. And if that does happen, where's the next point for the US dollar? Well, it's not down till this 111. There's really nothing holding it in here. It's what we call the dead space. So it's very unlikely to find too much support on the way down through here until that next level of support or demand zone down in this left-hand side. This is super interesting charting here for the US dollar. What the US dollar does, if it falls through, usually leads on to the stock market going up. And if you don't believe me, always do your synergies. If you load up something like the SPX versus the US dollar, what you're going to notice is that while the US dollar has been dropping, when it dropped here, look at this, look at the synergy. There's that ramp. Then we go up on the US dollar, we fall off. What about when we start to find some little bit of weakness in here? We start that initial ramp. Then we go against, remember the US dollar was going up and the stock market was going up. Warning, warning, warning signs are ringing everywhere. Then of course, that is the type of thing that you want to be paying attention to. So is the US dollar synergizing with the stock market? If the US dollar is going down, the stock market should theoretically in this current market environment go up. And that's something that we are looking at. Let's take a look at the euro. Was it positivity from the euro? It certainly was. US dollar weakness, the euro is often the proxy trade. It came exactly off that level that we discussed, which was the equilibrium zone. And we're going to find probably a little bit of weakness here, but ideally we move into this area up here, 99. And I'll just quickly check for you guys right now. We'll do it live. Let me just have a look here for you. And we'll find out how many people are short or long on this pair. So here we go, retail traders. I'm going to read these stats to you. 71% of retail traders are short the euro right now, and 29% of retail traders are long. So you can just see how wrong so many people out there get it. They probably got crushed through this rally here. And it kind of points towards pullbacks being met by bullish demand as you see that crushing number of retail traders trying to mean revert this or whatever they're trying to do. 99, that's the next supply zone. I'm interested in that zone being hit. Hopefully it does happen and it would work with the US dollar making a new low. Now, where things were a little bit different was gold. So gold came up. If you watched our live stream, you'll notice that we talked about this area here being kind of a very important zone for the markets. And that's actually where the shorters may come in. It went negative against what you would think. I mean, obviously you would think, well, US dollar's weakening, gold should go up. I think there's a mixture of things going on here. We saw probably a bit of a problem with China and the lockdown, maybe something in the policy didn't really strengthen gold. It is at a level of demand. Up here around this 1668 remains a key, let's call it supply or resistance level. And yeah, it literally fell straight off that zone. I don't really like the gold chart as of this day. And that's because the easy trades short were in here. The easy trades long was here, in my opinion. This one, question mark. The short here was certainly doable, but now we're starting to touch these sides too much. So yes, you could say resistance support. We trade within the range. I feel like after you've gone three, usually the fourth one can be the break level. So gold, probably come back to that later on this week. US oil is disgusting looking, frankly. I mean, there's nothing much to like. If you were guessing small time frame, I can see it made a new low, then broke through. There's that potential for here finding some buyers. If we do get a new high here, you would think it's probably going back into this supply sitting around 90. But it's pretty messy. Again, oil, I'm not a huge fan of doing the trade at the moment on oil. I've spoken at great length about how I'm mostly negative on the oil trades at the moment. And I continue to kind of remain like that. Some people will have like trend lines drawn behind here and they'll be following this down like a channel. To me, it's not really worth wasting too much more time on just yet, but we'll come back to oil. Don't worry, guys. We'll be back there eventually. XLY, XLP, what's going on here? So basically, it's showing us that people were willing to take risk in the last 24 hours. We've had this double top kind of pattern, and now we're ramping up. Now, I've got this little blue line here at 211 as a ratio, because what if it comes up here? Will it find some form of resistance and then sell back off? Well, that's a leading concept that we'll use when we're talking about some of these stocks. We'll go through Tesla first. Still, the weekly close doesn't have me feeling so great about this stock over the medium term here. I don't know why it closed underneath there, but that was certainly a very negative day considering everything else we had. We're coming into earnings. Now, it's only a few days. Remember, it's Wednesday afternoon. We're going to find out really what this stock is going to do. Is it going to rally and just continue to rally up or go down? I don't know. Most of you guys don't know. A few people in the comments, I'm sure, will be like, this thing's going to the moon, man. What a good deal. It's best deal ever. I'm still looking for that 180 eventually for Tesla. But for now, we're just kind of up, down in huge ranges as people position into this earnings. And I'm sure it'll be a highly volatile event. I'll see if I can get the implied volatility before this event occurs in one of our recordings. There's just not much to like really just at this stage. I would like to see it go past this 227. You'll see I've had an alert there for a little while. We'll find out whether it can do that. Let's move over to Apple. And you can see here, Apple only really 10 days away from earnings now. Long leg doji, nice little bounce. Came off that demand block that we had there for ages. We had that there for so long. And we haven't got a new high yet, which would be at 148. So Apple continues to really just be in line with the stock market at this point. But it doesn't look negative or positive. It's just nice kind of level for it. And I can see why buyers return. Microsoft came off our long-term trend line that we've talked about for ages. It hit that level that I've been pretty patient for. Many of you would know it's my favorite stock in the market, and that's just because I think it's robust. It has a strong moat, and realistically, I do love the old cloud-based software systems. So when we talk about Microsoft, it's just really further strengthening. A lot of people obviously were interested in this stock off that trend line. I mean, it's up 8.29%, probably almost beating the market at that point over the low. It continues to ramp. Again, we'll look at the main market. Now, this is the one I did want to point out here. This is the weekly for Netflix. And you'll notice it's a totally different chart to the rest of the markets. We based after the horrible news that came out later on, and it's been basically accumulating position. Now, notice the volume has remained, I believe, relatively high in comparison to its previous volume range all the way through here. To me, that shows you that there are a lot of transactors and then someone big may be building a position. Now, if you look at the weekly, it looks like it's coming to a critical zone ahead of the earnings. You could see it's right at that peak. We look at the daily, strong day out of this one, 6.57. Clearly, the market is expecting better than previous times. There's still that huge gap that was left when that big sell-off. But it's a nice level. And I mean, if you were lucky enough to pick it up down the bottom, I guess congrats in the run up to earnings. Earnings will do what it's going to do, but you can tell it's at a critical point ahead of earnings. And that's generally what happens with stocks. They're either at a critical support or a critical resistance ahead of a big news event. And that's exactly what Netflix is doing right at that peak. Let's move over to the Ftse. We won't mention this too much. We just know that if we ever do close underneath this level here, it's going to mean potential watershed moment for the markets. That's what I'm looking at there. The DAX made a new high, so slightly positive here from the DAX, kind of points towards maybe we go towards 13,200 and that downward trend line that we've found to be such a great sell point now for 2022 so far. We continue to look at the DAX from this trend line perspective, because if we hit here, what are we reaching on the US stock market? Let's have a look at the US stock market here. I've put an anchored VWAP on it just so you guys can see. This was a big sell-off point back here in October the 7th, and we saw that huge sell-off that pushed us back down. Then we got the whipsaw action. Now, at the time of recording, we're continuing to ramp up through that really nice buy level. If you got that, congrats to you guys. If you didn't, never feel the FOMO, guys. You just always find the next opportunity. So sellers, where are you going to be? Well, they're going to be sniffing around thinking, can we get the gap fill that's over here? So, of course, we do have a gap that happened from that non-farms number. And then do we hit this level and potentially sell off? Well, we've got a previous little bit of structure through here. This is going to be a supply. You can see that there's also some resistance players that'll be here. And you've got that anchored VWAP coming off the last big swing. So there's a lot to like about the shorters and the bears potentially coming in here. If we snap that level, the next zone you would think we're going towards is 12K. So yeah, that 11.4 or 12K could hold the key for bears. And I could actually see the market ramping still further into these levels, making a new high, breaking through that 11,200, and then trying to get back into this level. That's going to be fairly significant. SP500 is similar. Here are some of our major unfilled gaps. Got one up here, got one here, which is going to coincide very well with, of course, the Nasdaq, if that happens. And then we have the one that we left on the Monday when we came out of the gate so strong indeed. If we go to the futures market, it cleans it up a little bit, and you can see here some of these key levels. So if the Nasdaq continues to run, if the S&P 500 goes up, we're reaching that kind of 3740, 3760. That will fill one of the gaps that's open. And if the sellers are going to come in, you would think they try around here. And yeah, that's where they might be entering. Now, if we rip that level, the next stop for these markets could be 3880 to 3920. This is a very, very big zone. And we'll talk more about that should it occur. These are the three main rip levels we have. So this level, we rip in, potential sell. If we go higher, we rip here and potential sell. And then if we actually get into this zone, there's that bigger sell. What you're looking for in each one of these locations is a turnaround story that will generally present on the smaller time frames, 1 minute, 5 minute, 3 minute, those types of ones. And you need to be willing and aware of how to see those types of opportunities. If you are interested in finding out more about how to see those opportunities, I'd have to recommend our advanced scalping course over at fxevolution.com. That's just like here in the watermark, and you can find out more about how you activate these types of things and learn to, of course, empower yourself with those types of trading skills. It's a pretty good course, and we're releasing it at this time, and of course I'm writing that one. Let's move over here to the 21st of October in terms of options expiration. Well, we know that we've already ramped up a bit. 375 is the max pain. The stock price is currently 369. So where did we just talk about that idea that the first supply was? Well, 374 to 376. So realistically, that max pain also sits where we could have some shorters coming into the markets. The put walls here are just huge on 330, 340. If for some reason we go into a watershed moment, you've got to believe that 340 will be met by huge buyers because they will not want to pay these two large options off, at least generally they won't want to do it. 360 also holds quite a lot of puts, and you'll see a smattering of calls starting to appear around that 390 zone and start to outpace the puts there. Very equal around that 375. Keep looking at this daily, guys. You can go to maximumpain.com if you're interested to find it out. It is interesting and worthwhile paying attention to. So we talked about Bitcoin as well, and it was frankly lackluster. In fact, the stock market was moving more than the crypto market. I still kind of maintain this crypto market, to me, is in the winter of the winters, and that usually means that we fall between 83 and 86%. That's what's happened each other time. Now, when those markets have gone down there, that would point towards 11,500 and 9,500. If you wish to trade crypto right now, you've got to be prepared for a lot of sideways action. We've hit the golden pocket from the pullback, and we actually sat there through the last significant amount of time. While the stock markets were making new highs, crypto didn't want to. Crypto's like, no, I'm cool with selling off this zone. Until it gets past 20,500, we can't really be sure we're out of this entire disaster. And look, most people are looking at this and saying, well, could this all be part of a big accumulation story? There's a decent amount of volume through it. We've got that max pain. We've got that spring potential. Yeah, it certainly could be. But you can see that on the smaller time frames, it's struggling here. Let's go down to the 5 minute and have a look at crypto. So nothing to show us that this market is willing to go down yet. But if I was looking at like levels, we'll get rid of the fib there. If I was looking at levels, you would want to see for the bears, they'd want to see it underneath this 19,420 zone. And if that does occur, you would think, okay, pullbacks could be met by sell demand there, at least on the small time frames. Got to be very careful in the crypto market right now. It is not the popular market to be in. Moving over to news for the week ahead, there's not that much outside of other countries, outside of the US, and of course the earnings season. As we scroll through here, we got the Philly Fed Manufacturing Index, 8:30 New York time on Thursday, and really just a couple of FOMC members speaking, some other stuff. Bullard's coming out. He'll be annoying, I'm sure. Bullard's always annoying. If you're interested in following us anymore, of course, make sure to subscribe, smash that like button, guys, and we'll see you in the next video. Thanks so much for watching. Bye for now.